For years, silver traders woke up knowing exactly when the beating would start. Asia nudged the price higher. London held it. New York opened, and almost on cue, one vertical red candle took the whole move back in seconds. That ritual is gone. In the same window where silver has jumped from the high 20s to roughly 3 times that level in barely 18 months, the one thing you could set your clock by, that morning smash, has quietly disappeared. No waterfall at the open, no elevator shaft, no dump that makes any economic sense. In an ordinary market, a missing red candle is trivia. In a metal that feeds the power grid and sits at the crossroads of money and energy, it is not trivia at all. It is the silence you get when someone who used to pay to keep a price down, to cheat the chart in plain sight, either stops caring or runs out of ammunition. If you are still living in the old script, you pay for it. You sell into dips that now get bought. You short spikes, no one is smashing anymore. You end up on the wrong side of a move that only comes once in a generation. And above those trades sits a bigger question. What happens to a debt-soaked financial system when one of its favorite pressure valves stops responding? Just as factories and solar farms are burning through more silver than the mines can replace, there is an answer written into the chart. A simple 5-stage pattern that shows how the daily beating died, how the market flipped from capped to accumulated, and how a 40-year compression finally snapped. It is about as close as you will ever get to proof that they stopped cheating. Once you see it, you will never look at a silver chart or the official story around it quite the same way again. To understand what that missing hit at the open really means, you have to see where it sits in the larger pattern. If you strip away the headlines and just watch how the market behaves, the story falls into 5 stages. Stage 1 is the daily beating, when the same kind of hit lands at almost the same time and trains everyone to expect pain. Stage 2 is the dog that does not bark, when that hit fails to show up and the market quietly shifts from selling rallies to buying dips. Stage 3 is the microstructure mutiny, when fake sell walls fade and real demand starts sitting underneath the price. Stage 4 is the trend flip, when the usual tools that used to mark tops start confirming a new advance. Stage 5 is the God chart, when a base that took decades to build finally breaks and the price behaves like a spring that has been held down for a generation. That is the framework. Stage 1 is what life in this market looked like while the abuse was still active. Being bullish silver felt like being in an argument with time itself. Through the night, you would watch the market build higher, orders stacking above the current price, momentum looking solid, and then the futures bell in New York would ring, and a single oversized sell order would slam through the book. The market did not ease lower, it dropped in a straight line. When you see that kind of move, you are not looking at someone trying to get a good exit. You are looking at someone trying to make a point. A miner hedging production or a fund taking profits does the opposite. They spread their selling out. They work orders into the flow. They look for pockets of demand so they do not crush their own price. You only unload that much paper into a thin moment in the day if you are willing to take worse prices in exchange for control. That regular hit became the real pulse of the manipulation, the signal that said to everyone on the other side, do not let this price escape. Over time, it trained the entire crowd. Short-term traders started jumping in front of the usual hit, selling just before the time it normally arrived. They got paid for doing it, so the habit deepened. The old market was built on that feedback loop. The chart and the psychology reinforced each other until the abuse felt like part of the scenery. Then, over the space of only a few weeks, the usual shock simply did not come. The clock reached the familiar moment and nothing happened. That first missed blow was the crack in the facade, the moment when you could finally start to see that whatever was driving stage 1 was losing its grip and the rest of the pattern was about to reveal itself. Stage 2 is where the market stops acting like it remembers the old beating. The first real sign something had changed was not a giant spike or a new record, it was nothing at all. Traders sat there at the usual time, coffee in hand, waiting for the familiar hit. The candle dipped and then steadied. Sometimes it paused, sometimes it started to grind higher, but the old red knife simply did not appear. Once or twice you can shrug that off as noise, but when the hit keeps failing to show up day after day, the absence itself becomes the pattern. At the same time, the day chart started to behave differently. Instead of every bounce dying and every rally stalling, you began to see a floor rising underneath price. Each pullback stopped a little higher than the last. Levels that would never hold before suddenly did. That is not the behavior of a market being sat on from above. That is the look of one that is being quietly accumulated. And this is where memory turns on its owners. For years, traders had been trained to sell into that familiar moment. They tried to front-run the pain they were sure was coming. Now they were selling into dips that kept getting bought. The old tactic, the one that once made them feel smart, turned into a trap. They sold low, then had to buy back higher, and their scramble to cover started feeding the very move they were trying to avoid. That is the heart of stage 2. The hit goes missing, and with it, the old script, and the crowd that was conditioned to lean one way finds out the hard way that the current has already turned. Stage 3 lives inside the candles themselves. In the suppression era, the daily chart wore a particular look. You would see days where price tried to push higher, only to leave a long shadow at the top and close weak. Those shapes were the mark of something heavy sitting just above the market. On the order book, that weight showed up as thick layers of sell orders stacked a little over the current price, a fake ceiling that made people think there was no room to run. Often those orders were never meant to trade. As soon as price came close, the wall would jump away and reappear a little higher. It was a bluff designed to drain confidence. In the recent phase, that visual has faded and a different shape keeps showing up. Now you see candles with a small body near the top and a long tail below. That tells a very different story. It says sellers pushed price down, thought they had a break, and then met a buyer who was ready to take everything they threw and still lift the close back toward the highs. That lower shadow is the signature of real demand sitting underneath the market. Big players do not usually chase price with huge market orders. They sit on the bid with what are sometimes called iceberg orders, large buying interest broken into small visible pieces. You see a few contracts resting, they get hit, and more appear at the same level. From the outside, it feels as if the market has discovered a concrete floor. Every time it leans on that level, it holds. Those new hammer candles are not random noise, they are the footprint of that quiet absorption. Another old trick has been fading at the same time. In the past, you could watch a quick staircase of small sells walk the price down a few cents at a time, not to find a fair level, but to start a slide and flush out stops. Now, instead of a staircase down, you see the market pausing at one range, then stepping up to build a new base a little higher. The weight that once sat above price has shifted to interest that sits below it. The fine print of the market has changed sides. By the time you reach stage 4, the change is visible, even if you never look at an order book. The larger trend tools that traders use to track momentum start to confirm what the candles and the tape have been hinting at. Take a simple one, like the relative strength index. In the old environment, whenever that line pushed into the usual danger zone, around 70 on the daily chart, it was almost a countdown to a reversal. People learned to sell there because intervention so often followed. In a real trend, that same indicator behaves differently. It can stay hot. The line pushes above 70 and stays pinned there while price keeps climbing. Anyone still treating that reading as an automatic sell signal finds themselves shorting into strength and then forced to buy back, adding fuel to the rise. The moving averages tell a similar story. For years, when price reached the long-term average, it would often get smacked back down as if it had hit a live wire. In a true shift, the shorter average finally crosses up through the longer one and, more importantly, does not immediately fail. Price starts to bounce from those lines instead of being knocked away by them. And what used to act like a ceiling turns into a floor. Volume joins in. A measure that adds up the trading done on up days and subtracts what is done on down days stops drifting sideways and begins to climb ahead of price, which means more metal is changing hands on green days than on red ones. That is accumulation, not distribution. Even the way price interacts with its own volatility changes. In the old game, any push to the edge of the usual range was quickly yanked back to the middle. In the new one, the range tightens and then stretches as price walks along the upper side, dragging the average along with it. Finish the picture with the closing print each week. In a market that is being managed, late week hits are a way to send people home nervous and ashamed of being long. In this phase, you start seeing the opposite. The weekends near the highs. People are willing to go into the weekend holding, not hiding. When the momentum gauges, the averages, the volume flow, and the weekly closes all begin to agree. You are no longer looking at a string of lucky days. You are looking at a trend that has turned and a set of tools that, after years of being used as weapons, are finally just measuring what the market wants to do by itself. To see why that shift in the market was almost baked in, you have to step away from the screen and look at the metal itself. For several years now, silver has not been a tidy, balanced market. Each year, more metal has been used than has come out of the ground or been recycled, and over the last 4 years, those gaps have added up to hundreds of millions of ounces disappearing from stockpiles. That is not noise. That is inventory being eaten. A big part of that story sits in solar. 10 years ago, the silver inside a panel was almost an afterthought. Today, solar manufacturers on their own take well over 1/10 of global silver demand, and that slice keeps growing. In 2024, industrial use of silver hit record levels, and by the time prices punched through the old highs, analysts were saying that the thin layer of silver in each cell had gone from a small cost to something close to 1/3 of what it takes to make the panel. Put that next to how the paper market behaves. On one side, traders treat silver futures as if they are an endless, weightless abstraction. On the other, real factories are trying to build an energy system that does not work without that metal while watching one of their key inputs triple in price inside a year. The suppression game can drag on while users are relaxed and warehouses are full. It gets very fragile once the marginal buyer is critical infrastructure that cannot easily switch to something else. At that point, every hard slam in the price has to be backed by real bars leaving real vaults. Thin those vaults out far enough, and the tape starts to reflect the physical truth, whether the old players approve or not. There is another layer that almost never makes it to television, and it lives in the gap between the futures screen and the storage room. When most people trade a silver contract, they are just swapping paper promises. Only a small slice ever turns into actual delivery. The machine runs on the assumption that most people will roll or settle in cash. Behind that assumption sits a hard limit. In places like COMEX and the big London vaults, only part of the reported stock is formally set aside to satisfy those futures contracts. Another chunk meets the standards but belongs to people who have not agreed to let it be used in that way. Those piles have had to absorb year after year of drawing metal out to cover real-world shortfalls. Now imagine what happens if the psychology changes at the same time as the chart. If instead of rolling their contracts, more and more long players simply say they want the metal, the system does not collapse in a movie-style vault raid. It strains. The gap between the futures price and the true cost to get bars into a hand or into a factory starts to widen. Spreads stretch, premiums rise, rules get tweaked, and the promise that the paper is as good as the metal looks less solid. That is the real choke point for any attempt to sit on a price. You can play games with candles and spoof orders as long as people are happy to settle for numbers on a screen. Once too many of them ask to be paid in metal, the room to play shrinks fast. When the chart shows large money-building positions and the physical side is already tight, you're looking at a market inching closer to that line. All of this sits on top of a much longer story written across the biggest charts. The daily and weekly moves matter, but they are still zoomed in. To really weigh the disappearance of the daily smash, you have to stand back and look at decades. If you sketch a line from the spike near $50 an ounce in 1980 across the peaks that followed and out to the recent past, silver draws a broad bowl over about 40 years. Then a long shallow drift lower and sideways tagged onto one side. People call that shape a cup with a handle, but the label is less important than the time span. Most chart formations play out over months, maybe a few years. A base that takes most of a lifetime is a different animal. The longer a market is pressed down, the more energy it stores, and the more dramatic the adjustment when the pressure finally fails. In silver, that last grinding stretch from the early 2010s into the mid-2020s was the period many point to as the height of the suppression effort. Each burst higher was sold into. Spikes were faded. Retail enthusiasm was used, then punished. Meanwhile, other assets did the opposite. Stock markets in many countries climbed to repeated records. Property prices in a lot of cities doubled or tripled. Gold pushed to new all-time highs above $4,600 an ounce. Silver, in contrast, spent years trading well under its historic peaks, at times at less than half of the blow-off highs of 1980 and 2011. That kind of divergence is hard to defend in a world where the physical metal is genuinely scarce. Over the last couple of years, that pressure has finally given way. From the high 20s at the end of 2024, silver has driven into the high 80s and low 90s, setting new records. The move has come in sharp steps rather than a slow drift, with each surge launching from a higher platform than the last. On the longest chart, that looks like a clean break out of the old lid. The downtrend line that kept a ceiling over silver for more than 10 years has been broken, tested from above, and held. In simple technical language, what used to be resistance is now behaving like support. The old ceiling has turned into the floor. If you measure the depth of that 40-year cup and map it from the place where price broke free, the rough target lies far above where we are, in the $80 to $100 area and beyond. History adds one more uncomfortable point. When a real-world commodity with tight supply finally escapes a base that long, in a financial system already heavy with debt and prone to inflation, it rarely stops politely at the textbook goal. The move tends to overshoot, sometimes with force. That is what the long view of silver is quietly pointing to now. Not just another cycle up, but a full repricing of what this metal is worth in a system that has spent decades trying to keep it quiet. We have seen this kind of story before, just with a different metal in a different decade. In the 1960s, 8 central banks formed what was called the London Gold Pool. Their job was simple. Whenever the free market tried to nudge gold above $35 an ounce, they would pour official reserves onto the market to force it back down. For a while, it seemed to work. The charts looked calm, the peg looked solid. Underneath, the strain kept growing. As the United States printed more dollars to pay for Vietnam and domestic programs, foreign holders began to do the obvious thing. They sent the paper back and asked for metal instead. By early 1968, demand for physical gold was so intense that London did something almost unthinkable. It shut the gold market for 2 weeks. When trading reopened, the old arrangement was broken. Central banks could no longer pretend to set the price by decree. Within a few years, the gold window was gone, and the price was on its way not to 40, but to 850. The point is not that silver will trace the same path or hit the same numbers. The point is that once a suppression scheme hits the wall of real demand, the chart stops following the old commands. The interventions that once looked all-powerful fade into a last, nervous defense of a level that the real world no longer accepts. When you step back and look at silver through that lens, the pattern we have walked through stops looking like a collection of interesting quirks and starts to look like a single story told from different angles. The daily hit that trained everyone to expect pain has gone missing. The tape that once rolled over at every rally now keeps finding support on dips. The fine detail of the order book has flipped from fake weight above price to real interest below it. The larger trend tools that used to light up before interventions now stay aligned with the advance. Away from the screen, the metal itself is running tight, with years of deficits in critical industries competing for supply. On the longest charts, a base that took most of a lifetime to build has finally let go, and price is already trading well above the level where the effort to sit on it began. Any one of those could be dismissed as noise. Taken together across behavior, structure, indicators, physical flow, and deep history, it is hard to call it random. The tricks that once pinned silver down do not seem to bite the way they used to. The players who relied on them either cannot or will not use them at the old scale. For most living investors, this may be the closest thing they have ever seen to a market in this metal finding its own level. That does not mean the path will be gentle. Real markets swing too far in both directions. There will be sharp sell-offs, ugly headlines, and attempts to revive some of the old games in smaller form. But the tape has already given away the central fact. In a financial fight, surrender is not announced at a podium. It shows up as the missing blow that everyone was braced for and never receives. On a chart that has carried 40 years of bruises, that kind of silence is its own kind of shout. At this point, you can look at the silver chart and see the full arc for yourself. The vanished morning hit, the rising floors, the steady momentum, the tight supply, the decades-long base that finally broke, and the echo of earlier suppression efforts that snapped when they met the limits of reality. The open question is no longer whether the rules changed. It is how you choose to read a market where the old referees seem to have stepped back at the exact moment all that stored pressure is finally being released. In the end, you have to decide what carries more weight for you, the official story, or the lines on the chart that kept recording the truth, even when someone was trying to lean on it.